Hey, it's Jake here. My company was Assured Guaranty Limited, and they're a credit protection company, and through its many subsidiaries, they provide credit protection products to public finance, infrastructure, and structured finance markets in the U.S. and across the globe. They were founded in 2003. They are based in Bermuda with over 150 offices around the world. And for the rest of this video, I'm going to give an overview of the current situation they are in, a recommendation for the optimal capital structure, and for the dividend policy, as well as an analysis of the company's performance since its IPO. I give a one-day report on the IPO, a 3-year report, and a year-to-date report. Assured Guaranty has a current share price near $28, about 154 million shares outstanding, and a current debt-to-market value ratio of around 18%. For my analysis, when I looked at the income statement, I found there was a lot of variability in the income, and although it showed growth near 30-40% year to year, a lot of these costs and revenues were related to gains and losses on credit derivatives, which will effectively equate to zero when they mature. So for the purpose of my evaluation, I ignored these items, which made the insurance company's balance sheet and the income statement look more like a normal company's. So I only looked at costs and revenues related to premiums and investment income. So for my 10-year forecast, I projected revenue growth near 6%, which is a little higher than the current market growth of 4% in the last 5 years. And the reason I have an optimistic view for this company is one major reason. As the world economy is improving, there will be less debt holders defaulting on their debt, which means less payouts and expenses for Assured Guaranty. And as the economy improves, Assured Guaranty should improve even more as they're taking in more premiums, more companies are having their debt insured, so they will see higher growth and success. For the optimal capital structure, I recommend that Assured Guaranty levers up to reach a 28% debt to market value ratio. And this would increase firm value by about $1.7 billion and bring share prices to around $39, which is a roughly 32% increase from the current standing. This will also take the current credit rating down from a single A to a double B rating. I did not want the company to fall below this level, as this is the lowest credit rating of its closest competitors. And I also believe it's important to keep the credit rating higher to an investment grade for long-term health. Assured Guaranty can also maximize shareholder value by choosing an optimal ratio of dividends and share repurchases. Currently, Assured Guaranty offers a progressive dividend. It has increased ever since the company's IPO in 2004. This past year, they offered a dividend of 44 cents. On the topic of share repurchases, they have implemented several different 2 million share repurchase programs in 2007, 2010, and 2013. And my suggestion is that Assured Guaranty simply switches from this progressive dividend policy to a constant dividend policy, effectively decreasing the payout ratio over time. So given their 20% payout ratio now, that would effectively decrease over this 10-year forecast and effectively increase shareholder value. For the initial public offering, Assured Guaranty chose to go public around December 2003 and filed for an IPO, and they went public by April of 2004. The lead underwriters were Goldman Sachs as well as Bank of America. And for their first day returns, they opened up at $18 and closed the day at $17.80. This is a one-day return of negative 1.1%. And this isn't typical for most IPOs. The average return on a one-day IPO is 19% based on data collected all the way back from the 60s. So although the stock closed below the opening price, this isn't a signal of pessimism from investors, but more of a sign that the underwriters accurately priced the stock when they did the book building. So they were able to nearly maximize the amount of equity capital that they raised. When looking at the 3-year performance since the IPO, AGL has actually beat the majority again, as they have outperformed most of their competitors and the market from 2004 to 2007. Their return from 2004 to 2007 was around 58%. And most companies' 3-year returns after the IPO is 7% below the market standard and below their industry standard. So I think we can attribute their success to the fact that the economy is growing very well from 2004 to 2007, just before the credit crisis, and AGL did well during this time because they weren't forced to make any payouts to debt holders who were defaulting, because there were no companies defaulting during this time. Everyone was doing very well. And when we extend this analysis to look from their IPO to today, we see that AGO has done pretty well, but they have not done as well lately in the past 4 or 5 years, as they have underperformed from the S&P return average. But they have outperformed the insurance industry average. As you can guess, during this global credit crisis from 2007 to 2009, they did very poorly as they were forced to pay out large sums to companies who were defaulting on their credit, on their debt. They paid a large sum of to the likes of $29 billion to AMBAC and $13 billion of U.S. public debt finance to CFIG Assurance North America. And ever since the economy started to improve, AGL has wavered a bit, and their returns have been pretty normal in the last 2 years for the insurance industry. So to conclude, I recommend that Assured Guaranty change its capital structure and dividend policy to maximize value for shareholders. They should increase their debt by about $1.5 billion and effectively raise their debt to market value ratio to 28%. The credit rating will fall, but the firm value will increase by over 30%. And I recommend that Assured Guaranty changes from a progressive dividend policy to a constant dividend policy to take advantage of the time value of money on capital gains increases. And yeah, that's all I have to say. So thanks for watching my video, and have a good weekend.